Say, what's up if you watching? Welcome back to the channel. Baby, here we go walking about them at the federal down now. 3.5 years, this is cutting interest rates. Every time the time money shakes, the stock market shakes. If you want to know what this means for your money and investments, stay tuned cause I'm about to break it down. Find the fun in the Super Bowl, you hit the like, and subscribe, and you comment below. The Federal Reserve cuts interest rates when the economy starts to slow down. This happens when unemployment is rising, businesses are struggling, or inflation is not a big part of the problem anymore. A rate cut means people borrow money, which means people spend more and businesses can grow fast. Think of it like the Fed pressing the gas pedal to keep the economy moving. But here's the important part. A rate cut is not always good news. Many times it's a sign that the economy is weak and the Fed is trying to keep things from getting worse. Let's look at history to see how stocks have reacted to rate cuts. In 2001, during the dot-com crash, the Fed cut rates many times, but the stock market still went down because many companies' earnings were falling. This cut slowed the drop, but could not stop the bear market that was coming. In 2008, during the financial crisis, the Fed cut rates all the way down to zero. Stocks still fell hard, finally bottoming out months later. Liquidity was there, but fear was stronger. In 2019, the Fed cut rates even though the economy was still doing fine. Stocks went up, the S&P 500 rallied into 2020 until the pandemic hit. In 2020, the Fed made emergency rate cuts when the pandemic started. Along with government stimulus, this caused one of the fastest market recoveries ever. Tech stocks exploded and the growth companies gained huge value. In 2023 to 2025, investors are once again hoping that the new rate cuts will push the market up higher. History shows that the first 6 months to 12 months after the rate cut often brings rallies, but only if the economy avoids a deep recession. The lesson is clear. Rate cuts do not always save the markets. Sometimes they create rallies, other times they just slow down the fall. What does this mean right now? Rate cuts usually help growth in tech companies the most. This is because cheaper borrowing helps riskier companies expand faster and investors are more willing to buy. Bank stocks can go either way. Lower rates make it harder for banks to earn profits on loans. Dividend stocks can also struggle because lower rates make bonds and safer investments more attractive. So in the Fed cuts rates today, we could see investors move into riskier assets, more money into tech, and more ups and downs in the stock market overall. The Fed only cuts rates about 3.5 years. Each time the stock market reacts differently depending on how strong the economy is. The smart move for investors to watch not just the Fed, but also company earnings and the bigger economy. If you found this helpful, make sure to leave a like. As the markets are pushing towards all-time highs, let's dive into our accounts and see what plays we need to be diving in so we can get the max return off our investment these next 3 months. Today was a phenomenal day. Account went up 71% today, and we would have made double what we put in. And y'all seen the last video, I started dollar cost averaging into CoreWeave about 3 weeks ago and started an account with about $2,200, and I put in my option on CoreWeave. We sold our position today for $4,000, a call option, basically meaning that we seen price pull up and we were expecting price to go higher, and we sold it around 9:05 this morning. August 22nd, we bought the call option for $1,945, and we saw this option that it was a great strike price and as well expiration. It expired January 2026. We're currently now in September, and this is the secret to my options that saved me losing thousands of dollars. If y'all know, I started off investing, I was throwing money away. Whenever you start off your career as an investor, you're always going to lose more than you make at first. But once you realize what you're doing and you put your life more towards what Christ wants you to do and not being greedy, taking your profits, taking them out, saying thank you, appreciating the blessing that God gave for you today, and just moving on, then you start becoming more mature as an investor. And one thing that I was doing was just letting these go by, these little days I would buy for low prices, and my contract would be worth more than it was, and the market would quickly turn against me and I didn't have that profit no more. I had up losing everything. Countless stories like that in the Bible where people in the same position, they were having a lot of resources that God trusted them with, and they end up just losing it all just because one sin that could be in the way, or one problem that you're doing, one mistake that you could be doing that messes up everything. So that's the same mentality you want to do as an investor. It could be one thing that can be throwing away your whole strategy or your whole purpose if you invest in by one decision that you make, worldly or a short-term satisfaction emotion as a trader, and it just throws you off your A game as being an investor long-term. CoreWeave contract now just went up from $1,900 to $4,000 as we sold it today, this morning. And from August 22nd to September 10th is about 2 weeks of just holding the contract. It's already doubled in value. Meaning if we bought 10 contracts at $1,900, and that will be only worth about $19,000 that we would have to pay for that, right? So if we pay $19,000 for this contract and this contract doubles in values, if you have more capital, you're always able to flip it and do the same thing. It's the same mechanism. Somebody has $1 million, they can buy a contract worth of this much right here and it turn into $2 million. The percentage always stays the same. If you get 100% gain from 1,000, then it's always going to be 2,000. So if you do a 100% gain from $1 billion, it's always going to be 2 billion. So this is a good thing about the stock market. From compound interest, put in $1 a day so you can grow more tomorrow. Think of it as planting seeds so we can put more effort into more what God wants us to live like, not above our means. And he just wants us to live a simple, fruitful life. And that was just one move from the day CoreWeave. Still looking into CoreWeave. We have a price target for $200. The thing about investing is you want to be investing diligently. Whenever you see profit, you take profit. Okay, we would have noticed the same patterns and mistakes we're doing. Are we too heavily on risky assets like options, or are we long-term investing, buying shares of stocks and balancing out our portfolio? And this is what real YouTubers out there don't really tell a lot of people. People are too caught up on quick hype on trading rather than focusing on the concept as investing with economics in general. And once you really understand yourself, then you really master how you can take advantage of the same way the world reacts to just business, supply and demand, news in general. I always think about whenever there's risky options, the time decay is going against you whenever you buy call options. If the closer it goes to expiration, the contract can be worthless. It's the closer it gets to expiration. And that's a lot of mistakes people make dive into options. They want to hold to the last day until the milk expires. So that's the same thing with your options. You always want to get rid of your options and sell them when you see profit so it doesn't expire worthless. If you want to take profit, then no profit. You might just want to take the loss on some contracts whenever you see the market goes against you in market condition. You might see it be in a bull rally or uptrend, but the trend breaks. You always want to have a strategy to get out that option and not risk too much on one option. That can get you from being in the kingdom back to working in Wendy. So guys, it seems it's all on Wall Street. So always be an intelligent investor. Let's dive in. AMD, I bought an option that expired in 3 weeks from now, September 2026. And you see these options cost less than the options that expire 6 months to a year from now. And those options are more risky to time decay. So the closer they get to expiration, with these close to date options that expire a few weeks from here, they can become worthless the closer they get to expiration. But they have more opportunity to profit the more the stock goes towards desired. If it's a call option going towards upside, the stock call option could appreciate really fast. After I waited at least months for the stock to collapse down to the downside and it fall down a huge percent, between 30 to 40% in the last 7 to 3 months, I'll buy it. I put a call option on it, and whenever it's at the dip and it falls so hard, I continue waiting. And then once I see a bottoming out in the company, I put a call option as an intelligent investor. You don't want to put your portfolio out too much in one asset. Too many call options can end up blowing up your account. I always want to hold between a few call options at a time, just because if the market's going to be doing that bad, then all the other all stocks are going to be doing bad. It only takes one of them to hit. And keep in mind that AMD went up to $164 today. It broke past the strike price. AMD strike price where I bought was $157.5, and this strike price is just basically the price where the market price is near what your call option is. And market was at 151 when I bought this $310 call. AMD performed this huge spike down, and we ended up selling it the following 2 days, the AMD call option, for $830. And this one right here is an even better scenario of that 100% gain or 150% gain. We see that call options are easier for you to get that 100% gain, meaning price double. In order for a stock to get 100% gain, it has to go from 50 to 100, 100 to 200. In order for a call option to get 100% gain, it just needs to move $10, a good $10 to $20 to get 100% gain. And just because you already have 100 shares of one option. Now, option is basically whenever a company, you get a contract with an expiration date that gives you 100 shares of a company. That means every dollar goes up, it will appreciate $100. or every dollar goes down, it will depreciate $100. You'll be losing $100. And this one's way more riskier than someone that buys a single share at a time. And you know, you guys, we hit on United Health. United Health shot up to $347 after being at $300. And you know, this company's been beat up. We still buying the dip right here. We got way more room to go towards upside. We got to $628 price target for United Health. Now that Warren Buffett invested $1 billion into this company, it's getting huge government contracts. I love where the price is at right now. We're just going to keep seeing huge green candlesticks every week and every month with this stock right here. So you always want to be dollar cost averaging every week and every month into United Health for the next 6 months to a year. I hope you guys like this video, learned something new. Make sure you go to Sofa Academics and copy the latest merch, and make sure you hit the like button, subscribe if you're new. I'll see you guys in the next one. We out.